All right. Looks like we're live. Hopefully everything's working well. Been a while since I streamed. So hi, welcome everybody. Anybody who watches this on the replay. I don't know how many people will show up live. We'll see. See, I suppose. So yeah, it's been a while. Long time no see, guys. My life kind of went into a bit of a crazy tailspin in December after the last time I streamed, fortunately. Uh, but things are a little bit more stable now, so hopefully I will be back to streaming regularly again. It was pretty much just enough to kind of even keep managing my portfolio and doing some other research on the side. And frankly, even for a while, I wasn't even able to do much research. But at least for the last month, I've been doing a lot more research again. But either way, so we're gonna talk about a decent amount of stuff that I've been doing here today. As the title says, we're going to be talking about housing quite a bit. I know we talked a decent bit about home builders. I know I was kind of going in on my individual company research in various industries that I was looking at, industries that I had kind of interest in based off of various kind of themes that I was focused on. And I was going deep on specific companies, trying to kind of identify quality assets within specific industries, and then also doing some management assessments alongside that. Back here on this spreadsheet was where I was doing that. Let's see, audio notification from YouTube. Hopefully my streaming quality works well today. We'll have to see about that, I guess. Out here, this these spreadsheets where I was kind of doing assessments of the quality of various companies based on various factors. And with home builders in particular, I was looking at backlogs as well as the inventories, and then also the amount of lot years that they had. Also taking into account their market share as well as their employee levels relative to their sales and a few other things like that. Also, their geographic location of their sales. That was a big factor for me, which is definitely going to be a relevant discussion here today because really at the end of the day, home building is very much a regional industry. So it's definitely something you have to kind of take into account is the geography in which they're operating and all the dynamics in place there. But anyway, so this was the stuff we talked about in the last stream I did. But I've gone and done a whole bunch of other stuff related to that. But I've also done kind of some other side projects as well over the last couple months, which we're going to talk about a little bit as well. In fact, I'm probably going to do some discussion of those things first because I kind of just want to get those things out of the way since those are just kind of like core economic research I did a little bit on the side. And then the home builder stuff is, of course, meant to kind of like filter into my actual investment process because really I am doing all that research because I am interested in home builders. I do think there are some deals we had in the home builder space, but since the home building space is known to be super cyclical, I've been doing a lot of research to really try to understand exactly where we are in the cycle. Well, really, in terms of where we are in place of multiple cycles, different types of cycles, because I think that has a big effect on it. Especially like because there's some cycles that take place over a 2 to 5 year period, which is really like the debt refinancing cycle. That's something that kind of has its effects on the business, but happens over a relatively short period of time, 2 to 5 years. But then there's also the business cycle itself, which has to do with the combination of debt and capital within a cycle, and that takes place more over a like 5 to 15 year period. And then there's other cycles beyond that, more like demographically based cycles. And so the reason why I bring that up is because I do think that there is kind of like um, some some positive aspects about home building because of one type of cycle, and then other negative parts of home building because of other parts. So you kind of have to think about these things together. So first and foremost, here we are looking at my portfolio. There isn't too much to be said about my portfolio since the last time we talked. Um, I think I had already taken a position in Lenarb last time we had talked. So I've taken that. It's a relatively small position. And who knows, that may not be the long-term choice that I have in the home building space, depending on really the results of my research. But I do think that that's the company I want to invest in. There's a lot of reasons I like them. I like their management team as well. So there's a lot of reasons why I picked them first and foremost. But if if I decide maybe another opportunity is better in the home building space, maybe I'll switch to them. But we'll see. But that's the position I have. But it is small so far. So the idea, what I'm trying to figure out is how heavy I really want to invest in them as well, which is potentially pretty heavily. Um, on that front, also FG, obviously my number one position for a long time now. I've been also been doing a lot of research in the annuity space as well as the pension transfer space. With their 10K coming out here in the near future for 2024, I am hoping to get some details off of that one to be able to really put together and fine tune my next more complete model for them for the next several years of their business. And frankly, a lot of that research has kind of been getting me a little bit more bullish on them lately. So who knows? I might be actually somewhat doubling down a little bit on FG in the near future, which is good because I've been hoping to concentrate more and more on my position. So I'm hoping to see whether or not I want to be concentrating heavily onto Lennar in the future. I am still doing a lot of research on the gold miners to try to figure out some of them that I want to do some more concentration on. I did take a new position in NGD. I technically had a position in them in the past, but I did kind of start a new position in them again, so I might be concentrating a bit more into them as well as the Silver Corp and more in the future. Um, I'm looking into Generac. They'll also have their 10K coming out here in the near future, the next month or so. And I'm curious about them because, frankly, I see them as more about fair value right now. But I'm kind of looking to hopefully go deep a little bit more on them to be super sure about that because, I hold them and I like them a lot because of the growth opportunities I think they have in front of them. But I do think that they're actually pretty well priced in terms of those opportunities. So I don't necessarily want to continue to hold them if there isn't a super great opportunity in front of them to be had. But I don't want to sell them out of them too quickly. So the point is, I am looking forward to that 10K so I can kind of like see exactly where I'm going with that position going forward. Because part of me thinks it might be time to say goodbye to Generac potentially in the near future. But on the other hand, they also have come down a little bit in price in the most recent past. So it's maybe not the most opportune time to sell exactly right now. So maybe we would hold off a little bit more for a little bit of a higher price. But the point is that we may be coming near the end of the holding on that one. The point is I don't know exactly how much more upside there is in relative to fair value, and then at that point it's just market returns. So I don't know if we have other opportunities, we might take a look at that going forward. But anyway, that's kind of enough I really want to say about the portfolio. Like I said, there's a lot of other stuff I kind of wanted to talk about here today, especially a lot of the kind of economic research I've been doing on the side. So one project I've been doing has been this project to kind of take a look at the business cycle and a lot of factors related to it because obviously I've have a lot of interest in economics. People who've been watching my channel for a while will know that I'm interested in economics as much as I am in investing, and I talk about it quite a lot. But the point is, I've been trying to kind of get better at having a good understanding of where we are in the economic cycle and basically having a good idea of like where how likely it is that we're going into recession or not. Just by having a good grasp of what the current data is, not really trying to make solid predictions or anything like that. Not predictions, just understanding where we are. So, and a lot of this research I've done is actually based off of some other people's research that I've seen online. In particular, one economic researcher by the name of Darius Dale, who I'm a big fan of. I would recommend anybody look up his content. His very well researched content uses great data, good analysis tools within that data, and I think he's very good at explaining very complex things. So point is, I've kind of modeled a lot of what I've done here off of that. I've tweaked it quite a lot and done a lot of things a little bit different and picked and choose the things about it. But point is a lot of this is inspired by what the stuff he did. So the point is he broke down the business cycle into kind of like a lot of different kind of factors, which I've kind of done somewhat similarly. So what I've done here is I've kind of grouped them into different categories. One, here, let me go to the cycle so you can kind of see them here. I'm specifically breaking down the business cycle into liquidity, stocks, profits, growth, credit, employment, and inflation. Then you'll notice I skipped yield curve here, but because that's kind of just an extra one that's added in here to kind of just add as an extra signal, but that's not really a separate cycle, just kind of a signal within a cycle. But basically, there's those separate cycles: liquidity, which basically just derives how much money there is for the movement of assets and flows within the actual business cycle itself. Then there's obviously stocks, which is the things we're all invested in. Profit specifically refers to the profits related to stocks. So like yes, specifically when I'm talking about stocks, I'm talking about the S&P 500 here, and then profits, I'm specifically talking about the earnings of the S&P 500. Specifically when I'm talking about liquidity, I'm talking about the M2 money supply, and we're also specifically talking about 3-year growth of these things specifically. So the 3-year growth of the money supply, the 3-year COGR of the S&P 500, the price COGR, and then the 3-year COGR of the EPS as well. And then growth is GDP, also at a 3-year COGR. Then for credit, I'm using the total commercial banking loans and leases. Credit specifically how much debt is being extended to new businesses so that they can grow their businesses. Then employment is on the unemployment rate, but it is inverted. So you can see kind of here within this. But the idea is that these things move down as we go into recession. So everything's kind of like indicated so that it's specifically moving towards a cycle. So if you look at this graph right here, this isn't like a specific moment in history. This is actually an amalgamation of various points in history. What I did is for each of these signals, I went back, got all the data going back to the end of World War II for all those signals, compiled all of that data together, and then took a look at all of the recessions that have occurred since the end of World War II. These are the expansions of the recessions, the dates at which they began, the dates at which they ended, and then took a look at where all of those data points were going into those various recessions. So you can see I have the recessions listed here, and then I have how many months prior to recession, up to 2 years prior to the recession, and then going forward to 4 years after the recession began. Basically, kind of trying to chart a map to say what does all of these data points look like going into and out of recession on a typical basis, and taking kind of the median case across as many recessions that each of these signals had. Like, and I did this for all of them. And going back over, just realized the policy. Why is the policy? Hold on a second. Just I don't know. I might have to fix that later because I just realized one of them was missing. Technically, I'm supposed to have a policy signal here, which is the federal funds rate. Because that one should be before liquidity, but just realized that one's not in here. I'm gonna have to fix that later. But either way, the point is for each of these signals, policy, inflation, growth, employment, the yield curve, the loans and leases, credit extension, liquidity through the M2 money supply, the S&P 500, the S&P 500, EPS, all those things. I look at all of the various recessions we've had prior to or after the World War II up till now, and the 24 months prior to the recession, and up to the 48 months after the recession. What were each of them like relative to their median basis going into and out of it? And then I take the median case across each of those signals to get an idea of like what does the typical recession look like across each of those signals. So you can kind of get an idea of it right here. Now, starting with it, you'll notice like liquidity is already significantly negative several months, well, actually a couple years prior to the recession. So it's one of the first things that deteriorates is the money supply growth. Then you see the yield curve start to invert, and then over time, the yield curve eventually uninverts, going close to the point where the recession actually begins. But prior to that actually occurring, you also then at that point start to have the profits of stocks deteriorate, specifically the S&P 500 deteriorates. Then you end up having stocks themselves deteriorate. Then alongside that, growth starts to deteriorate. You'll notice that growth hitting zero and going negative is pretty much coincidental exactly with the moment that the recession begins, which makes sense considering that's how we define recessions. And then at that point, pretty much in line with that, you have credit deteriorating. You'll notice that employment and credit are actually pretty closely aligned. The purple and the black line are like very, very close to each other throughout this, which makes perfect sense if you think about it, because the business's ability to get credit is really going to drive their decisions to continue to extend more employment or whether to lay off employment that they already have. So those things just make sense perfectly together. And then the most lagging factor of the business cycle is inflation. Inflation is actually generally relatively high going into the recession, and actually peaks after the recession is essentially already begun, and takes up to a full year for it to really start to break down and go below trend. And really, that's the thing you'll notice is that about 6 months after the recession begins, is everything is already below trend except for inflation. Then it takes about a year or so after the recession begins for everything, including inflation, to have come below trend. But by that point, a lot of the other signals are starting to actually improve and move back up over the trend. Um, some of them will do are a little bit volatile and have a little bit of some double dipping type of action, especially the stocks and stock profits. You'll notice they'll kind of come up, dip back down a little bit, come back up. But again, that partially has to do with the fact that this is about how fast these things are growing relative to true trend. So if it comes back up above here, potentially that growth was so fast that if the growth just slows significantly, it could drop it below. So it partially has to do with just how the signal works. Now I understand like this is kind of a lot to look at, all these lines right here. So there's one way that I've kind of like simplified it is by essentially trying to take all of this and amalgamating into one signal by essentially saying like, what is the median across all of these, except for inflation. That's one thing I did with this is I excluded inflation when doing this because as I noted, inflation tends to be high going into the recession. It takes a while for it to come down. So I think of it as more of a lagging indicator. So essentially all of the coincidental and preceding indicators we took a kind of a meeting case across and then put them together into a composite signal, which I have right here. That's specifically the blue line. The blue line kind of shows what is the total signal of the cycle look like going into the recession. And then you'll notice it comes right down to here to about zero prior to the recession for like about 3 months prior to the recession, and then going negative as the recession begins, uh, hitting a bottom about kind of like 3 to 6 months into the recession and then starting to improve, and then going out of recession about 18 months or so. Again, this is the typical case. Some recessions are very, very short, some are very long. This is the typical case. We're kind of looking at all of the recessions and amalgamating it to get an idea of like what is kind of the archetype of a recession look like. And that's essentially what we've done here. We've, like I said, taken all these various signals of the business cycle and compiled them all into this one line right here, which is the blue. And then, well, the red line, as you might notice, it says that that's where the current cycle is. Well, let me come back to this other slide right here, which takes all of those cycles and says, well, where are we right now? Now, right now, I should say this is actually as of the end of last year. So pretty much all of this data was either December monthly ending data or November monthly ending data, because some data pieces come out at a little bit of a lag. So it's all like 1 month or the month prior. So I did this at the end of the year. So this is December and November data essentially that gets you right here. So technically it's a little bit behind. I haven't updated it yet. But the point is you can take a look at this and see where we are. And obviously I will say it looks super negative looking at this, but it's also not very in line with the typical case in a lot of ways. So it's like I will say it's like as bad as this sort of looks, there's kind of a lot of caveats to it if you really like look at like what's where very specifically. Liquidity looks like as you would expect it to look going into a recession. It's also worth noting that it's kind of coming down here like this relative to this one, which shows it down for a while and then kind of going into the recession itself. So it's like you could argue that that one's not necessarily in line with it. Yield curve is also sort of in line with it, but it hasn't actually come all the way up yet necessarily. Inflation's already down below trend because we've already had high inflation and then experienced disinflation. So that in many ways, you could argue is bolstering the fact that we're not in a recession, because I do think that the inflation being high is part of the reason that the inflation, or part of the reason we get dragged into a recession in the first place, is that the high prices essentially drag the rest of the economy downward. So the fact that we've already experienced that disinflation could be bolstering us a little bit to a certain extent. Though obviously there's still high inflation in certain categories, and some people believe the inflation is going to be coming back somewhat over the next year or two. I actually am one of those people to a certain extent. So there's that. And then stock profits have already declined significantly to in terms of the trend. So that also is in line with the inflation or in line with the recession theory to a certain extent. But the stocks have also already been down. But to a certain extent, you could say that that means that in some sense we were already in recession and we're kind of moving out to recover. And that kind of makes sense to a certain extent because a lot of people kind of felt that way about 2022 and part like maybe the first half of 2023, right? Like a lot of people kind of felt like we were in recession, like the rolling recession people were talking about. So in some ways, you could say like this picture of where we are currently depicts that, where it's like it shows us as though we already were in recession in some regards, and as though we maybe are going to go into recession, but not that we are in recession right now. And so it's this kind of like weird sort of not quite not quite like the typical case picture. Like I said, like it's a weird amalgamation. But the thing that's like clearly the case is that credit is still solidly above trend, growth is still solidly above trend. Now, as I already pointed out, unemployment is a little bit below trend. It's only a little bit below trend, and credit's above trend. Now, I had pointed out before that employment and credit are usually very solidly in line with each other. So the fact that they're not in line with each other now means one of them should correct it towards the other. So it's either employment's going to be dragged back up to the trend and above trend because credit is strong and growth is strong, or credit's going to be dragged kind of downward a little bit because employment was just ahead of the curve a little bit somehow, and then growth is going to be pulled downward too. And I think stocks will kind of follow with whichever case that happens to be. So it's either stocks are going to go up because growth and credit are already strong and are continuing to be strong, or these two are going to deteriorate and then stocks will deteriorate with that. So it's like that's kind of where we are. Like I said, it's like we're clearly not in recession because growth and credit are very strong. But a lot of the other signals are pretty weak, and so it's like they could pull those other signals downward. So coming back, like I said, come back over to the composite signal. Composite signal seems to want to believe that we're in recession, though. So that's the thing. But like I said, it's like there's a lot of caveats to that. There is a lot of caveats to that. So I don't know. We'll see how that pulls out. But it seems to believe that the recession signal began like 6 months ago, essentially. So I don't know. We'll see. Now, this other chart I put together is the historical case of how this composite signal works. I was like, wait, let's take a look. How's it done in history? So here's all the recessions since the end of World War II. Really, we begin with the 1949 recession. I kind of skipped the one right after World War II because it's like a post-war recession, so it's partially caused by the troops coming home. But anyway, so the point is here you can see it does a pretty good job of aligning itself with recessions. It doesn't always predict it super well. Sometimes it's kind of going negative kind of late in the recession, but it's worth noting that like even the NBER, who's the organization that declares the recessions, they don't typically declare until it's like half over themselves or even close to over. So, you still might be better than they are potentially. But a lot of people might have already been calling either way. But some of them are very early, as you can see right here. Like this one was calling recession like 2 years early. In this particular case, some of them are a little bit late. But point is, it certainly does a good job of at least capturing the vibe of are we in expansion or are we in recession, which is kind of the point of this. But yeah, it certainly seems to believe that we are in recession. There is a decent amount of smoothing going on in the signal. I'll point out, but nonetheless, it still does a pretty good job of that. So I don't know. Like I said, there's a lot of caveats to why you could say that this is potentially one of those kind of fluky cases, because there are some fluky cases in here where it doesn't. Like I said, it's either super early, so that kind of might as well be wrong, or it's like double dipping after the recession is kind of already over, which you could say also means it's sort of wrong if it's kind of double dipping. But like for example, like here in the recovery after the great financial crisis, there were concerns in 2001, 2012, as well as 2013 that we were maybe going to go back into recession because of various issues. So it's like one of those things where it's like this is capturing something. It just didn't end up being called a recession at the end of the day, right? So you sort of say the same thing about 2020 as well, right? Like we had the pandemic, but it wasn't a business cycle recession. And then it did go negative in 2021, which is a little bit late on that one. So as you see, like the signal is not perfect at all. Like I said, there's all sorts of weird caveats and flukes you can explain away things with. So just because we're negative here doesn't mean that for sure anything's happening, but it is interesting, something that we should maybe keep our eye on. And like I said, this data is technically a month to 2 months old now, so I do need to update it a little bit, but it doesn't really change that quickly. It's one of those things where it's like it kind of takes some time for it to really shift. It takes at least a handful of months for the most part. So I have a little bit of time to update that. So cool little thing, like I said, little side project I was working on was this business cycle research, which does seem to say that we should maybe be concerned, but like I said, there's also caveats to that. And then in terms of that, I mean, obviously the news over the last week and over the weekend in particular is the tariff discussion. Mr. Trump, our new old president, has decided that we are putting tariffs on, although they don't come into effect until Tuesday, I believe. So technically, he kind of left a potential Monday option for gauging people's reactions and potentially maybe getting some people to cave or as well. I kind of think the strategic play there. So we'll see what happens with that. But the point is that itself could also have its effect on the business cycle. So we'll see what happens. We'll see what happens. It could be very interesting over the next year to see what happens economically speaking. And then beyond that, I was also did some other research on some other stuff, which is kind of stuff that we've talked about many times before. Looking at the market, I have obviously been very focused on the bond market and treasuries and inflation, and how inflation relates to the bond market, and my expectations that we basically have kind of bottomed in inflation, and that therefore I think interest rates shouldn't really be going down too much. Or in particular, I definitely think it's especially like the long-term rates are basically right where they ought to be, or maybe a little bit lower than they ought to be. You can argue about the lower term rates; they should maybe come down a bit or something, depending on which ones we're talking about. You can talk about that all day long. But the long term rates are the ones that I definitely am like, I think they really ought to be where they are. And anyway, I kind of did some more research on those topics as well over the last few months. The first piece of research we'll talk about is I was taking a look at the holders of treasuries. I had heard some talking heads online kind of talking about some things that were happening in regards to this, and I was like, well, I kind of want to look into this as well. So I compiled all the data on the various different types of entities that hold U.S. treasuries across the entire board. How many U.S. citizens hold them? How many banks hold them? How many does the Fed hold? How many does foreign governments hold? How much does foreign private citizens hold? All sorts of things like that, right? Like, people talk about the various who owns the debt, right? So I kind of like went to look, and I was like, okay, well, let me take a look at who currently owns how much of the debt. And I'm not, because I'm like concerned about one person saying they're not going to pay us, or one person having some sort of control over us or something like that. People often bring up random things like that when we talk about those subjects, but that's not really what I'm bringing up. The thing that I'm most curious about is the price sensitivity of the buyers. Okay, so it's like, depending on who's buying treasuries, what is the reason they're buying them, right? Different people who buy treasuries have different reasons why they're buying, and those reasons might drive how much they care about the price they're getting, the yield they're getting for the treasury, right? So like if you're the Fed, you don't care too much about the yield you get, because you're buying them for like monetary policy reasons. You're buying them to help uh, gauge and affect the monetary system in whatever way you want to according to your policy. So the price doesn't really matter to the Fed, right? And this is true of other entities as well. This would be true of foreign governments to a certain extent. Not entirely to foreign governments. Foreign governments are going to have some sort of sensitivity to it, but they're gonna have some partial case where they're going to be kind of gauging their own monetary policy. And then I would say that's also true of regulatory bodies, like various financial entities here in the United States. They also are not going to be very price sensitive to them, because a lot of them have to have them for various capital reasons, various regulatory reasons, in order to have the appropriate safe types of capital in order to extend loans on. They have to have a whole bunch of treasury. So like, they're not as price sensitive, or they're not as price sensitive either. So that's kind of something I did here, is I started kind of like grouping together the different holders of U.S. treasuries by their price sensitivity. Like I said, we have federal agencies and trusts, which are not very price sensitive. The Federal Reserve, which is not very price sensitive. The U.S. regulatory financial system, which is not very price sensitive. Other domestic, which is like US citizens, and that would also include technically hedge funds, and other investors here domestically, they're going to be price sensitive. They're going to care about the yield very much. And then foreign governments, they're going to be somewhat price sensitive, but also somewhat not price sensitive. And then foreign private, that would be kind of like just foreign private citizens, foreign hedge funds. They are probably going to be pretty price sensitive as well. So I was kind of like taking a look at this and combined all these things together. And here's what I got. Here, these two charts on the top and bottom. These are the total amounts here of the ownership, and these charts go back to 1981. So we're taking a look at this over time. You can see the different categories as I kind of just described here over time. And then here I have a rolling change. I think this is 5-year rolling average I did. Is that what I did? I believe, yeah. It was a 5-year, yes, 5-year rolling average change in the percentages over here. So you can see that's why some of them go below zeros, because that's showing when they're changing or going down in their percentage of the ownership. That doesn't mean that they're selling necessarily, but that just means that other people are buying and they're not buying, or they're buying a lot slower than somebody else is, for example, right? So you can kind of see how that works. And so, like I said, these charts are a little bit messy to look at because it has all those different categories. But then I started to group them together. So I had my price insensitive, partially sensitive, and then price sensitive, and group them together. Now, like I said, the partially sensitive one is the foreign governments, and then the price sensitive one is foreign private as well as domestic private. And then basically all the other categories, we called them insensitive because they basically own not because of reasons related to investment. They're not like looking at the yield and saying, oh, I need this to be a certain price in order for me to buy, in order for me to get the yield I want. They need it just because they need the treasury. They just need something that says US Treasury because US Treasury is good, right? Like that's the reason why they need to get it. Or they need to get it for some sort of like political, like economy reason, where they're trying to like manage the system in some sort of specific way, right? And so that's why we're calling them insensitive to the price, because like they're buying it as a tool. They're not buying it as an investment. They're buying it as just like this tool that they need for a specific purpose. For plumbing, it's basically for plumbing. And so anyway, we can see how these categories kind of mix together. You can see those insensitive buyers, they made up a huge portion for the 80s, the 90s, the 2000s. And so what I would argue is that this is one of the reasons that interest rates were lower than they were, or as low as they were for as long as they were, and were able to be as low as they were, because there was a huge amount of people who were just buying the treasury, just buying them at any price. They didn't care about the yield so much. They really just wanted to make sure that they got the treasuries for various reasons. Now, some of those insensitive buyers, technically, they could be trying to push the yield higher. So that means their insensitive choice could be to not buy it, buy at any price. It could be to technically sell at any price too. So this technically doesn't capture that effect necessarily. So it's a little caveat there. The bias isn't always to buy, is basically what I'm trying to say. The point is that it's a bias that has nothing to do with finance. It's a bias that has to do with regulatory reasons. And you can see the changes over time here too. But anyway, so moving on from this chart though, what I then did further is I took the partial group and I basically said, let's just call it 50-50. Let's just say half of it is insensitive, half of it is sensitive. And so I just did that. I just kind of added half of this category to one and half of it to the other, so that we just had the two. Let's see what the two look like. And you can see this chart right here. And then the 5-year rolling change as well going on right here. So the reason why I did this is, like I said, I had heard some people talking about this online. So I very specifically kind of wanted to kind of check the data and see if what people were saying was true. And it turned out it is true, which is to say that, I mean, depending on, like I said, some of these are subjective decisions I made here about how to group these things. But people had been saying to me that that price sensitive buyers were now taking over the market. That was the theory I was hearing online, was that price sensitive buyers were now taking over the treasury market. Or you could say, like, people often talk about bond vigilantes. That's another thing people talk about, is that when people think that governments are mismanaging their debt markets, that eventually investors will come in and will start to force the governments to do what they think is the correct thing financially. And they call that bond vigilantism. And so the point is like for bond vigilantism to even work, first of all, you have to have a significant effect on the market. So you kind of have to have a strong percentage of the market for that to work. And so, like I said, I'd heard people saying that bond vigilante is going to come back. One, because people were concerned about inflation, but two, but because also the price sensitive buyers had started to take over the market again. And lo and behold, like I said, that sure seems to be the case. They actually have become more than 50% in the last year or two or so. So very, very interesting thing that I kind of, like I said, went looking into. It was things I had heard online, and I kind of wanted to confirm or deny that in the data. And like I said, you could quibble about some of the subjective decisions I did and how I split up the data. So if you made different decisions, you might get a different outcome. But I think the decisions I made were reasonable, and incidentally, it sure looks like that's the case. And so, like I said, getting back to why I brought this up is that I think that this is one solid reason to believe why, especially the long end of the curve, like the longer duration treasuries, 10 years, even 5 years to a decent extent, but 10 years and 30 years especially, are probably not going to be coming down a whole lot, I don't think, unless we have a recession, at which point it would probably be a temporary downward move, um, but probably to be reflexively back upward afterwards, because frankly, there's a lot of price sensitive buyers now. And then, like I said, that's just one thing I had been working on. I also had been working on a bunch of statistical models related to treasuries as well, because there's a pretty known strong correlation between real GDP growth and inflation, and which ends up being like nominal GDP and the long-term treasuries. And so I started like looking at just how strong that ended up being, and specifically looking at real GDP and core PCE. I found, yeah, pretty strong relationship, like 72% correlation, 52% explanatory power coefficient of determination. And kind of within that model, I looked at, I was like, okay, well, on a range of real GDP and a range of core PCE, what would I expect the treasury to be? So anywhere from 3.5% to like -3% almost of real GDP, and various spaces in between. Like I said, this is just kind of like saying, if it was this, what would it be, right? So if real GDP was at 3.5% and core PCE was 2.55%, what would I expect the normal treasury to be? And I use the outputs of this regression model, which says that it should be x times this time variable plus x times this variable plus this intercept. So it's a linear model. And putting it together, it's saying that like if you had those things, you would expect 5.17%. And then on the other end of the curve, for example, if I had negative almost 3% real GDP, and then slightly negative core PCE, which is like, recessionary kind of scenario, right? Like inflation has collapsed, and real GDP is now significantly negative. What would I expect nominal GDP, the 10-year again, nominal 10-year treasury GDP, nominal 10-year to be, not GDP, I said GDP, but nominal 10-year, you would expect it to be 1.14%. Again, according to this model, which has 52% explanatory power, which is pretty strong, but technically isn't, explaining everything. And then, like I said, various shades in between here. It's worth noting that right now, real GDP is at 2.5%. So it's kind of like halfway between these two categories right here. That's what the most recent print came out on the advanced one, literally this last week. And then core PCs, where's core PC right now? Like 2.5 or something like that, like right over here or something like that. I can't actually remember off the top of my head anymore, because I think that's where it stalled out, right? Uh, double check. 2.8. We're at 2.8. Okay, actually, so yeah, we're a little bit higher than that. We're actually up here. So yeah, and then kind of taking maybe an average between those. That means the nominal treasury, just average between these, which is a kind of a funky way to look at it, but that gets me 4.9% if I just averaged across these cells right here. 4.9%. And going back over here, we're currently at 4.5%. We peaked out at like 4.8 or so in mid-January. So, but look at this nice solid trend upward on the daily chart, upward trend on the weekly chart, upward trend on the monthly chart. Say what you will about trends, obviously. So, but
just saying, I feel like long-term rates are at best right where they ought to be. At best, they're right where they ought to be. At worst, they have room to go up, and i.e., treasury prices to go down, because price sensitive buyers are sensitive to that, and the fundamentals support that. Like I said, so it's one of these things where it's like, whew, I don't know, guys, and obviously, if those go up, that creates pressure for stock prices to potentially go down. The dollar would continue like to be strong, go upward, which is in line with the same thing. So a lot of things I would say. Be wary of these things. Be wary of these things. I could be super wrong with these things. I'm looking at historical data. I'm using statistical tools. There's also a lot of economic theory involved there. You can quibble about all three of those things, but all three of those things together are kind of pointing at treasury rates. Like I said, it's like at best being right where they ought to be. At worst, really ought to going up. And then, like I said, obviously though, technically, like I said, I was saying that based off of where we currently are with real GDP and core PCE. You could say, well, this is where we're headed in various point shades of both those things. Maybe you think we're going back down to 2% for core PCE, but then maybe you think we're still going to stay at 2.5%. So it's like I was saying, between those things, then it's going to still be somewhere around here. That puts us at like 4.5, 4.3 to 4.5. Like I said, we're currently at 4.3, right? So like I said, we're currently at 4.3. This model says that that's 2% real GDP and 2% core PC, right? 4.3% for nominal 10-year. That's what this model says, right? So like I said, it's like the only reason that you would think that 10-year treasury is going down is if we're getting a recession. That's literally the only reason to believe that it's going to substantially go downward. Again, this is the long-term end of the curve I'm talking about. The short end of the curve can do whatever. The Fed can continue to cut rates, and the short end of the curve will do what it wants, but it's just going to steepen the curve. That's basically what I think is going to happen. It's just going to steepen the curve further, which generally is puts a lot of pressure on businesses that are trying to borrow. So that could push us further into recession. So that's what I say is like that's kind of where I see us at. I know in some ways I feel like I've been saying a lot of these things for a long time because a lot of these things have taken longer to pan out than I thought they were, but they are panning out. They are really starting to actually pan out the way I said they were. They've just taken a lot longer than I thought they were going to. So one of those things where gotta be paying attention to these things. Obviously, doesn't mean this should affect any of your investment decisions in the short run because who knows how that's going to affect things in terms of stocks coming back over the cycles as we talked about. Stocks tend to deteriorate well before they tend to recover faster than a lot of the other things. Same thing with the EPS. So it can be a little bit tricky to kind of try to time that in terms of those things as well. So it's one of those things where um, who knows what happens with stocks in regards to that. Just kind of keep doing your thing in that regard. So anyway, let's actually talk about some more stock related stuff. Where obviously we're not really talking about stocks too much specifically, but let's talk about the housing industry, which kind of at least relates towards stocks. Which one of the things maybe it's worth paying attention to these things because if you're going to be going into housing, which is a highly cyclical industry, you might want to have a good idea of what's going on in the business cycle. So it's a good reason to have brought up all those things as well. So I've kind of been looking pretty deeply at the housing industry from a lot of different layers. I've been compiling a bunch of the data off of the Federal Reserve website as I like to do. They actually had a lot of housing data on there, and they actually have a lot of the housing data grouped by region, which is very very helpful considering how much of it is affected by different regions. So firstly, let's actually discuss regions. We kind of have a good idea of what we're talking about in that regard. These are the official regions of the United States according to the U.S. Census, and that's how the Federal Reserve splits up their data. And so that's kind of how I chose to kind of think about the data. You can quibble how you want to have it, and I'm actually going to be adjusting that data to a certain extent myself. We're going to look at a bunch of it in these four groups, but once I start comparing it to actual companies, what I'm going to do is I'm actually going to group all these just into two regions, specifically West and East. And East is literally going to be a combination of the other three groups: Midwest, South, and Northeast. Now, that's not exactly how I would have ideally wanted to do this, because you might be like, wow, three of them all combined into one and then just the West. I was like, I would have kind of preferred to maybe had like three groups with like a Midwest and a Northeast or something combined together, and they kept the South and the West separate or something like that. And the reason why I'm doing it is partially because I was looking at a bunch of other companies in various home builders and looking at how they have their segments split up geographically, and some of them have it split up very, very strangely. And in particular, Lennar has a very, very strange setup to theirs. And Lennar is one of the ones I'm most interested in. So it kind of made it difficult for me to to split up the census regions in a way that I would have liked, which, like I said, would have maybe have been like Midwest and Northeast together, and then the South separate and the West separate. So unfortunately, I'm kind of just stuck with West and East is kind of a big region, which, like I said, not exactly ideal, but it works for my purposes anyway, at least, because it still at least keeps some differences about the West, which I do think is somewhat unique. But the South is somewhat unique too, as you'll see, because at least when we're looking at the regional data, we're going to be looking at all four. We'll have all four of them. It's just that once I start looking at the home builder companies, that's when it's going to start to be just those two together. So at least for the stuff I'm mostly going to talk about here today, it's going to be all four that we're talking about. But when I talk about maybe next week or whenever I talk about it, that's when it's going to be just the two groupings together. So anyway, these are the regions. Hey, it looks like we got some people in the chat finally. Olga and Scott, welcome guys. Nice to see you guys. And a handful of others seems like showed up according to my concurrent viewers. So if you just popped in, some likes would be appreciated. Please subscribe if you're not already. Join the Discord, link in the description below. Also hit the notification bell, and I'll make sure you get notified whenever I go live and all sorts of stuff like that. But anyway, if you do join the Discord, be patient. It takes a few hours or a day or so to be let in by one of the mods or me or something. So be patient if you get let in. You won't be able to really see anything when you first hop in, but please do become and join the Discord. It's free. Just have to be patient on that entry point. So anyway, looking at the regions right here. Like I said, it's very, very worth paying attention to the differences here, because as we get into the data, you'll see kind of what I mean. There's a lot more building activity in some of these regions compared to others, and the economic dynamics are very different in some of these than others, and that's really going to affect how you think about it. And then also the home builders themselves, some of them operate in the regions differently as well, which was something I had talked about when we had first talked about it. I had said, oh, I have my preferences towards this region versus that region. I had specifically said that I had my biases towards the Southwest and the Southeast, and I had my reasons for that. And that my reasons, I think, pay out pretty strongly in the data. Like I said, like I had those biases before I went and compiled all this data I'm about to show you here today. But man, does all of the data really, really show exactly why I had those biases. It was just like I kind of already knew it in the back of my head, a lot of these things. It just I hadn't put all of that data together. So anyway, coming over here to take a look at it, here's basically a whole bunch of charts, which if you want them, I actually made a PDF out of the charts and I put it in the Discord down in the housing chat group. So technically, if you want a copy of all this data, you can get it in Discord. But here I want to show you the spreadsheet. So first off, let's take a look at the populations. Here we have the populations of each of the regions. So right off the bat, the first obvious caveat there is the South, man. Look at the South. The South is just a behemoth in terms of population. And it's partially because, in particular, that they have both Texas and Florida there, which are two behemoths in terms of population in the United States, especially Texas. But the point is having both of them together, because like Texas is kind of like one of those odd states where it's like you could maybe have argued to put Texas in some sort of like Southwest grouping, or something like that, maybe. And you could I've also seen some people, at least like in like company segments, I've seen them also end up in like this kind of like central kind of segment sort of thing sometimes. So it's like you can kind of argue Texas to be put in various ways, but in historically speaking, it generally always has been considered part of the South. And in this particular case, you could also argue that including Maryland and Delaware is perhaps a little bit of a far extension northward on that case. But again, this is the census regions. I didn't make up these decisions. That's just kind of how these ones are. Um, Texas have their own. Yeah, and see, like Lennar gave Texas their own segment, and a few of the other home builders had Texas separate. So they definitely do that. They definitely do those types of things. Use your brain. What about Trump's stance on the border, though? What about Trump's stance on the border? That's not very specific. Like, give me specific. What do you mean about that? The same way, coming over here, the South, very, very huge population. The next highest being the West, and then I'd point out the growth rates as well. That's the other thing to point out is the difference in growth rates for both the West and the South comparative to the Northeast and the Midwest. And then, like I said, I'm going to be doing my kind of groupings together. So once I do my groupings together, it's really going to be the West, which is going to be very, very small population comparative to the combines of the others. Here we have the 3-year rolling CAGR of the populations there. So the South had a relatively strong population up here through the end of the last year, and the West has had decent population growth, but definitely not super strong. Whereas the other ones are a little bit on the weaker side in that front. And then down here, the reason why I kind of start, by the way, with population is because basically all the other charts I'm going to show you here are basically all going to be adjusted by per capita or per thousand or per million or something per capita like that. If they're not already a ratio of some form, they will be adjusted per capita so that we can kind of see it smoothed out over time, adjusted for those factors. As Scott says, labor for builders could be hurt, but the supplies Lennar needs is mostly U.S. only per what they say. That's true, at least for Lennar. I assume that's kind of like bringing some points related to the immigration thing. User Brain had said it will limit future population growth in the South due to migration. That is potentially true. That is absolutely potentially true. I would say that's potentially true for both the South and the West because yes, those would definitely be the places that are going to be getting the majority of the immigration that we've seen over the last the last several months. There was a dang, I wish I had remembered. There was some immigration related charts I'd wanted to show here today. Because I saw some interesting data. Because I will say this, my biases, I in general have always been relatively pro immigration. I understand a lot of people's frustrations with immigration in the last few years. So I personally think like I'm the type of person that can kind of see both sides of the argument, even though I do have my own personal opinions about what I think is better overall. I think I'm understanding of both sides, if that makes sense. But one thing that I found recently was I saw a pretty strong negative correlation between the growth rates, the resident population growth rates versus the immigration population growth rates. Everybody knows that the immigration populations had relatively high growth rates and they were coming in. So there was like two factors that were making those populations be making immigration have like such a strong effect on the population growth of these regions. But point is I've seen data recently that has kind of led me to believe that there's some reason to believe that if you have less immigration, potentially the native born population will actually have more babies. I'm a little, like I said, I was a little surprised when I found this data. It kind of ran contrary to my biases. And like I said, I wish I'd remembered to pull that chart up because it's one of those things where I wish I could show you it on the graph because it's one of those things where it's not something, like I said, it ran contrary to my biases. So it was not something I expected to see in the data. But I found it and I was like, oh wow, that's interesting. It was like a negative correlation between the resident population growth rate and the foreign population growth rates. Which makes me believe that potentially if there's less immigration, maybe we'll have more native born population growth. That's the long way of what I'm trying to say with that. I don't know. We'll have to see what happens at the end of the day over these next few years in regards to the immigration thing. Firstly, just how much of a halt in immigration will there actually be is one big question we have. I will say, if you look at the data, Trump did succeed in slowing down immigration pretty solidly in his last term, though it took some time for it to really get there. So the point is, it took a few years before it really started to show up. but he did actually manage to really solid to get there. And I would say this prior to COVID, because like a lot of people say, well, oh, well, he did with the COVID shutdowns. It was like, no, he in the numbers, like at least in terms of like the percentage of growth, he had halted the growth prior to COVID too. So it's one of those things where it's like presumably he'll get there as well. Again, maybe he'll get there faster, and maybe he'll get a solid reduction within that. I don't know. And so yeah, that could affect the population growth rates pretty significantly. But who knows what happens with the native population growth rates? That's kind of what I'm saying with that. Is like there's give and take potentially in that regards. You can make arguments for why, if people believe that there's more housing availability, maybe they're gonna have more babies, right? Like that's just one reason why you could argue why that would occur. But like I said, I don't know. It was just something I saw recently in the data that was like, oh, that's interesting. And then yeah, getting to what Scott says about the builder supply. It'll be curious to see how it affects the builders, because supposedly there's a lot of immigrants in the building supply. That's something I've been meaning to kind of like go and look at the data myself in regards to too, because it's one of those things where it's like you hear people talk about things online in regards to like, oh, this thing or that thing about the data. I'm the type of person that always likes to go and look at it, right? That's just who I am as a person. I go and make charts of data. That's what I do. So anyway, let's move on from the population part. Like I said, I begin with population because most of the rest of this data is then scaled by population so that we can kind of see what we're talking about in that regard. So like here, what I mean by that, total housing per capita. You can see right here, total housing includes single family homes, but also multifamily. So this includes the apartment supply effectively too. And then you can see this over time. Now, zero point 0.4 or zero point 0.5 or something, I'd point out to this total housing per capita. If you flip that 0.5 in flipped upside down into a 2, what that implies is 2 people per household. So 0.4 would be 2.5 people per household. Just to get you a sense of what this is, 0.33 would be 3 people per household. So you can see like this ratio, if you flip it upside down, technically gets you an idea of people per household. So you can see the reason why I bring that up is because you can see there's been this like solid drift up over time in most of the regions, not in the West though, which is something that's very interesting. I think the West stands out in this data pretty solidly, which is going to get to some of my bullishness in regards to some housing at the end of this. I will say it's because I do have some bias towards the West. I am still bullish on the West, and in particular, the home builder that I'm focused on, I think has more disproportionate focus on the West as well. So it's one of those things where it's like, in particular, I think the West is set up to potentially do well. The South, I think, is still potentially set up to continue to do well as well, regardless of the changes of immigration. But still, it's interesting to see here. What this points to me is that like I do think this looks like it's potentially stabilizing. So I do think we're maybe stabilizing out at about like a less than 2.5, but more than 2 people per household kind of level in most of these regions. What it looks like maybe we'll get a further drift up over time, but it looks like it's relatively stable. But the West, who knows? Maybe over time this will start to drift upward towards this. If it does start to drift upward over here, this would be homes being built in the West, right? Like this means that there's less homes in the West relative to the capita. So this is potential for more building in the West if these lines down here. Technically, you could argue that these ones can move downward over time, but if all 3 of these are grouped together and this one's down here, it kind of goes to show that this is the oddball out, right? So you would expect, therefore, that means more homes should be built in the West, according to this particular detail. Then there's the home ownership rates. That kind of goes in line with it too. We have high home ownership rates in the West, still relatively high home ownership rates in the Northeast, which is interesting to see, especially considering some of the other data, which we'll get into, because there's also a lot of multifamily, a lot of apartments in the Northeast relative to other regions, but still decently high home ownership rates. And then interestingly, apparently lower home ownership rates in the South and the Midwest. And what that kind of means in the combination between those 2 factors is that you end up having more like actual apartments in the Northeast versus then you end up having a decent amount of like homes being rented but not owned in the South and the Midwest relative to the Northeast. Obviously, you're going to have all of those things in all of these locations and a decent amount of them in all of them, but just like at least slightly tilted more towards the other, because I mean all of these are all still just between 60 and 70%, so they're still pretty closely grouped for the most part. But just little variances you see between regions. Then single family as a percentage of total building. So like the actual building that's being done in any of these given years on a rolling basis, how much of it is single family homes versus apartment buildings. And then voila, as I was kind of saying, lots of apartment building and multifamily unit building in the Northeast relative to the other regions. Just definitely one detail that you see that kind of stands out for that particular region. Rental vacancy rates kind of going along with that. I'm focused more on the home building aspects of it, but we do want to have like a good understanding of the alternatives to that, to the business model, right? The alternative is multifamily. It's like if you're either buying a single family home or you potentially go and rent somewhere, right? So that's why it's like we do kind of want to have an idea of these dynamics of like what could push people to go towards other things in other regions. The fact that there's less housing per capita in the West is bullish towards the idea that we could build, but it also means it could push this homeownership rate downward because people just don't have any choice. In fact, I would say that that's somewhat what we could say is what is happening to a certain extent. We see a downward push right here, but you could also say it's a little bit of a mean reversion to it. It's hard to argue whether or not this is the beginning of a trend or not. This also looks like it's in line with the other ones too. So hard to build a consistent narrative over any one piece of this data. That's kind of why I did so much of it, is because I think that like looking at all of it together kind of helps you really get an idea of what's going on in different places. But rental vacancy rates overall pretty relatively low. It's good to see because that's definitely going to be an early warning sign. People are gonna be abandoning their apartments faster than they're going to be abandoning their homes. We do see a little bit of a upward move in the south, looks like, but still relatively low and kind of in line with the longer term average, I would say. And these ones are also moving upward a little bit. The west and the northeast, it looks like a little bit, but still kind of in line. So still nothing super worrying. Coming down here, we're kind of moving past those factors now. Actually, taking a look at more of the price and the supply and demand and sales factors. Average prices for the total sold on a log scale, and then the 10-year rolling COGR for them. Really, you want to look at the COGRs, but at least here this gives you an idea of the differences between the regions. The Northeast has definitely the pricier of the homes. On the averages, 800,000, 900,000, crazy. 600,000 for the West, 400,000 and change for the Midwest and the South. And that's for averages. I do have the medians down here, so you can see like 300 and change for the Midwest and the South, 500 change for the West, and then 600 to 700 for the Northeast. So yeah, we do have the averages and the medians, and then the 10-year rolling COGR for each of those as well. Interesting to see just kind of the differences, both in terms of like where they currently are. The home growths really have leveled off pretty significantly. Obviously, that hasn't. This is for a 10-year COGR, so this doesn't take into account any like very recent uptrends. Like in the last few months, things have started to pick up, which I believe they have to a certain extent. That's kind of why I say that. So this is a 10-year rolling COGR, so it's going to be very much lagged in terms of any recent changes. But overall, they're kind of in line with the longer term average for on a longer term basis. Like I said, if we're looking at the most recent last few months or the year or so, it's going to be a little bit different in that regard. And comparing that with inflation itself, in those regions, kind of interesting to see. I did note that the West had a little bit of higher inflation for the kind of like the second Obama term and Trump's first term kind of time frame, that like kind of 8 to 9 year period or so after the GFC. The West in particular had notably higher inflation, not like crazily high inflation, but notably higher than the other regions, which is very interesting. And then there's some differences there in the peak in 2022, but as of right now, they're all pretty equalized on that kind of basis. And you could possibly chalk that up to immigration to a certain extent, potentially, like also net migration flows within states too. That's the other thing you also kind of want to keep in mind with these regional differences, which I didn't get on I didn't actually manage to find a chart for, but there's migration from outside the country in, but there's also the migration from one state to another, and a lot of the movements have been from the Northeast to the South, or the Midwest to the South, or the Midwest to the West, or Northeast to the West. There has been kind of a flow towards the West and South as well, relative to the other regions, from of the data I have previously seen. Like I said, I don't have that unfortunately here in this data, but still. So anyway, we looked also like at the average and the median prices. I did actually take a look at the ratio between the average and the median home prices here, which kind of gets you an idea of like the skew of the home prices in those regions, right? It's like how much is the really really rich pricey house relative to the cheap house in those regions, and how big is that skew? Because it kind of gets you an idea of just how attainable are some of the upper end homes in those regions, and here you can kind of see that average over time. It's interesting to see how pretty consistent it is, kind of like around 1.2 is pretty seems like a solid average across all of the regions. That's a little bit different in some of them, and they were also pretty closely tightly packed together up until the financial crisis. Then the Northeast seems to be pretty significantly higher, which is pretty interesting. Still also pretty significantly higher. But also I see a drift downward over the last kind of like 10 to 20 years, which is interesting because that's not necessarily what you would think in terms of things becoming more attainable. But like I when I say more attainable, that kind of assumes that you're already able to afford the lower end home, right? So if both the lower end homes and the upper end homes are both going up in price really fast, then the homes may not be attainable at all, right? Like this is just talking about the difference between those upper end homes and the lower end homes. This is like one way to gauge that difference, right? So things can they're becoming unaffordable across the board. But if you're already able to afford a lower end home, then the difference between the lower end home and the upper end home over the last 10 years in all of the regions except for the Northeast have actually come down a little bit, which is kind of interesting to see. Maybe not so much in the last year or two, but at least over, like I said, that 20-year period, there's a little bit of a downward trend there. So anyway, now getting into some of the more like meatier stuff that's actually really about like the housing market. A lot of this stuff is like kind of just like economic details about related to the housing market. And there I have some more stuff related to that too. But now we're like really getting into like the real solid differences about the market itself. Like here specifically, we have homes sold and homes for sale, right? Like so we're really getting into like the market itself. Homes sold. Now here you can see huge differences in the regions. Huge differences. The South is just a massive part of the market. Just massive. Look at it. Just huge. And we're doing this, like I said, on a per capita basis. It says per thousand capita, but I'm pretty sure this is actually per million capita. It's like um, six single family homes sold per million per capita per year in the South. And then, like I said, that's adjusted for population differences. So, like, obviously, as we already said, the South has a huge population difference there, but we've scaled this for the population differences. So these are already scaled for the population differences, which means that the market itself is just that much larger in the South. It's just that much larger, even when you take the difference in people into account. Maybe it has to do with the amount of actual size of the geography. Maybe if you did like a not just per capita but per square mile, maybe you would get a very different answer or something like that. Like that could potentially be a reason because like that would probably affect the West too. But if that actually would probably affect the West even more than the South would. But just like one thing I'm throwing out there, just to say it's like there's more than one way to think about these things. I'm doing it a per capita way of thinking about it, but because that helps adjust over time the population growth. That's the reason why I'm doing it. I'm not doing it because I'm trying to compare the two regions on a similar basis. I'm doing it because I'm trying to compare the one region to itself over time. But the point is like differences between the two regions. It's hard to say exactly why there's so many more homes being sold in the South, but I do think it has to do partially between immigration from outside, net migration between the states as well, as we were talking about, because there has been a significant flow southward and westward. So I think that creates this to a certain extent. But yeah, huge difference. But then, like I said, once you adjust for the per capita, the population levels, it's not so crazy the amounts of homes that have been being sold recently compared to the past. Because I've seen a lot of people bring up these charts overall without doing the per capita thing. People do that all the time. If I go to single family sold, let me just bring it up. But, over here, look at this. Like here, this is the total United States, but this is just in thousands of homes sold. So this is without doing the per capita basis. If you look at it like this, then if you look at right now, you'll look at it and be like, well, you'll ignore the GFC because you'll say, oh, the GFC was crazy, right? This is the housing crisis, crazy stuff happened here, so we can't count this. you'll ignore this and you'll come over here and you'll look at these peaks over here and you'll be like, okay, so this is where it peaked out, and oh man, look at how high we are over here right now, right? And so you'll look at this and you'll say that that means we've got to be super high right now. And so that's because you're not taking into account that there was a lower population here, and this is in absolute numbers of homes in thousands sold. So that's why it's very important to do those kind of like per capita changes. But like I said, per capita is just kind of one way to do it. Technically, there's multiple ways to affect it. But like I said, if you do the per capita, suddenly these previous peaks way back here in the 70s look a lot higher, don't they? They look a lot higher than we are now all of a sudden. And that's because once you adjust for the differences in population, you get that huge difference. So like here, even in the South, I would say is like, are we high right now? High. Are we really high? No, I wouldn't say we're really high. I would say we're slightly above average or at average, right? We're like at average, or and maybe like up here was above average. Here is kind of normal-ish, right? And then like on the West, clearly we're below average. Clearly we're below average in the West. In the Midwest, clearly below average. In the Northeast, clearly below average, right? So that's why it's like if you adjust for the per capita, it's very important. You can get these big differences. Now, like I said, that's only taking one thing into account. That doesn't take a whole bunch of other things into account. So just because that seems to be below average doesn't mean it shouldn't be. Maybe it should be below average, but you want to take that into account. So we do the same thing, like I said, pretty much for most of these other charts, are pretty much all have that kind of per capita thing going on because it really helps to kind of scale things appropriately. Homes for sale. So this is the inventories. I've heard people saying, making that same discussion where people saying is like, oh my gosh, inventories are at the same level they were in the housing crisis, which I mean, in the South, they're pretty close to that same level, but they were even higher in the 70s, is what I would say to that. So it's like, is that necessarily a problem? Not necessarily. And then there's also one thing that's very important to kind of think about is also the difference between when the numbers, the amount of homes that are sold reverts back to a certain amount of mean. That's going to take into account the differences in the sales. User brain, are you high? No, officer, I'm slightly above average. No, officer, I'm slightly above average. Nice. Good one. But anyway, so taking a look at the single home sale, like I said, we still see the same level, same kind of differences between the regions there. The South, just a huge market relative to the West and relative to the Northeast and the Midwest, but still kind of scale differences. Now, one thing what people often see in housing markets is to compare the homes sold versus the homes for sale, is they'll kind of take the ratio between the two, which is the months of supply. They take the ratio between the two and then multiply it by 12 to get the months of supply. So here I have those months of supply for each of those regions as well. And that's kind of one thing I want to bring up, because like if you look at the months of supply, it definitely makes it seem like we're at pretty high levels. But it doesn't take into account the differences here. So like if we're at like the lower quartile of home sale per capita in the West, which we are, then if you assume that maybe in like say 3 years time, it will have reverted back to kind of the median level of homes sold per capita, and that's going to bring down the months sale by basically that same ratio difference on that particular ratio. Like I said, for the South, you can see that we're actually kind of at about like a normal level of sales. So I would say that this is kind of, you're not going to see too much mean reversion in the months level for the South necessarily, but you would see a mean reversion for the West. You would see mean reversion for the Northeast. You would see mean reversion for the Midwest, which those are some of the highest levels of the months, like especially like the Northeast has some of the highest levels. So that's good. The mean reversion would affect them pretty strongly. Looks like I said, the South is kind of about where they ought to be, but they're definitely not one of the worst ones. This one's a little bit of a crowded chart to look at. And sorry, yeah, let's see if I put it to its own chart, it's a little bit easier to see where the numbers are currently. A little crowded right there. Yeah, see, like, okay, so yeah, the South is at like about 10 or so. So that's it's a little high in terms of supply. I would say the South is a little high in terms of supply. The Midwest and the West are not super high in terms of supply. And then the Northeast is high in terms of supply. But like I said, if you adjust for their sales level, then I would say not so much. So I would say the South potentially has a little bit high on the home supply level, but they also have some of the strongest economic dynamics. So it's one of those things where it's like it's hard to say whether or not that's a problem or whether that's just basically everybody in the industry just saying, nah, this is gonna roll through. We're gonna roll right through it. And to a certain extent, they've been right up to this point. So it's like it's they could be correct on that bet. But this gets to show that, like I said, my bets personally is more on the West. Why my personal preference is more towards the West. So anyway, we looked at the month supply, which takes into account the homes sold and the homes for sale, but there's also other ways to look at it too. I also take a look at the homes under construction, also still on a per capita basis. So this gives like the what supply is coming online, how much is going to be added to supply in the near future, right? And in terms of that, I would say that at least the South has come down pretty significantly on that front. They've all kind of come down a little bit, except for the Northeast, which has been relatively flat. But all of them have had this kind of like peaking level and then started to come down a little bit. But in particular, the South and pretty strongly in the West as well. So like I would say the South is kind of like around this kind of normal level at this point to a certain extent. The West is about a normal level, maybe even a little bit below it to a certain extent. You could say even the Midwest is maybe a little bit below its normal levels. And then starts, how many are starting its construction? So you can see like we're kind of moving backwards in the process. There's homes sold, there's homes for sale, there's homes under construction, there's homes that are being started, and then there's also permits that are being given out to start homes as well. So you can see that there's kind of this like process in the data you can look at of like each step that has to be achieved. Like they're first you get the permits, then you start building the home, then it's under construction for a period of time, then it's listed for sale, unless of course it finished construction and it immediately was sold to somebody, which is sometimes the case too, but very often the case it's listed for sale for a period of time and then it's sold. So there's kind of like this step-by-step process, which I point that out because eventually we're gonna have charts that kind of point out that very specifically. But you can see these charts are very similar in kind. So like all those ones, they kind of paint very similar picture. It's just like one of them maybe leads or lags a little bit more and is kind of you can use as a bit of a leading indicator. So that's why like in the kind of like weekly and monthly data in the markets, you'll see people bring up housing starts. People will bring up housing starts all the time. Not homes sold, right? Well, people will talk about homes sold too, but specifically people bring up housing starts. Why do they bring up housing starts? Because if a house has been started, it implies that there's eventually going to be a home sold. In fact, it may already have been sold, but maybe not. But not just that too, but also if a home is being started, then there's also all of the other things that have to be purchased in order for the home to be constructed. And then all the things that get purchased once the home is sold too, right? So there's a lot of economic data that follows housing starts as well as homes being sold. So it's kind of like a leading indicator kind of effect that people like to pay attention to here. So long way of saying a lot of these charts are the same. I'm not going into super high detail with them because they're basically all the same, but they're interesting to look at and very useful. And like I said, you can go get that PDF if you want from the Discord. I could put it in. So if you want to look at it very closely, feel free. Then I did also take a look at the ratio between single family starts and for sale, right? So like how many homes are currently being started relative to the ones that are currently being listed for sale. And this kind of gets you an idea of like just how much are they building on spec more right now relative to the current supply within that region. So it's like are they bullish even though they have supply? You know, it's kind of like a way of gauging that. It's like are they getting more bullish even though they sort of already have a bunch of supply there? And maybe they're right or wrong that you would want to compare that with like the sold numbers maybe to get a good idea of like just how accurate that is. But it's a good thing to look at, and I think obviously you can see like a huge downward movement going into 2008. So I think that shows that there is something to pay attention to here. But interesting to see the kind of the differences between the regions on that front. Like the Midwest in particular seems to have higher levels through most of this time series, much higher levels back here in the late 80s and into the earlier 90s, but a little bit higher here in the most recent few years and decades as well. Not as high, much higher, but still to a little bit, a certain extent. But still relatively closer. Just interesting to see kind of the ebbs and flows there. It's like I'm willing to build 2 to 4 new homes relative to the ones we've already got on inventory and potentially aren't leaving. Right. So it's like how many more new homes, and this doesn't take into account the differences. You still might be building in different neighborhoods, so it's not necessarily super apples to apples, but interesting to look at. Um, Now this chart is actually super messy to look at. It's really just looking at a regional version of another thing that I kind of wanted to show, which was something I did before I started putting all this stuff together. I was looking at housing data kind of more on a national basis at first, um, over a longer time frame, because frankly, on a national basis, you can get much longer of a time frame of a series. So I was really looking at like housing starts versus population, and total housing estimates over the last century, because I really wanted to get a really, really good idea of what housing looked like in the United States. I didn't. This is the thing, is like I think it's very easy to be fooled by what you think is a long period of time when it really isn't. So like a lot of people in markets think 10 years is a long period of time. It's not a long period of time. A lot of people in markets think 20, 30 years is a long period of time. That's not even really a long period of time. To be honest, even 100 years, depending on the context of the discussion you're talking about, may not be a very long period of time. If we're talking about like climate data, for example, 100 years isn't a very long period of time. Things like that, geological scales, it's not a very long period of time. Cosmic scale, not a very long period of time. So depending on the conversation topic, the scale of the time makes a big difference. So in housing, I was like, how far back can I go? And really, I got all the way back to the early 1900s for how national housing data. So here you can see like housing starts, 30-year rolling averages, and then looking at the population growth. Come over here. This is specifically the chart I wanted to point out, because I found this and I found a pretty strong statistical relationship that I wasn't necessarily expecting to see so neatly. And this kind of gets back to what I was saying before. I was like, what drives the differences um, here when you've already adjusted for population, right? You've already adjusted for the population. So why is there such a big difference here? Now, I would say is like, let's compare this concept here. Um, when you've already adjusted for the population, it's a ratio. So that means it's kind of similar to a PE ratio, right? So what drives the differences in a PE ratio, right? Like so one stock trades at 10 times earnings and at 10 times its trailing earnings, and another stock trades at 50 times its trailing earnings. What's the difference there, right? Obviously, the most obvious difference that should pop in your head is growth rate. The expected growth rate on that trailing 12-month earnings is the difference there. So even though we've already adjusted for population, which is how we got to a ratio, the difference here is probably the growth in that population, because we've adjusted for population, but we didn't adjust for the growth in that population, right? So what does it look like when you take those growth scales into account? And that's kind of what this complicated chart is about, because it's looking at all of the growth rates versus the housing starts over time within that. It's a little bit messy to look at because I'm looking at all the regions all at once. So coming back over to the national one, where we can look at just the national level, where it's a lot cleaner to look at. And what do we have right here? I have the year over year population growth for the United States going all the way back to 1900, and the housing starts per population going all the way back to 1900. I had to compile a few different time series to really get all that together. But look at this. Look at how neatly correlated that is. Isn't that just like chef's kiss? Like this is so clean, honestly. Like that, like for economic data, that is a very nice correlation to find, in my opinion. And the actual statistics themselves back it up pretty solidly as well. It's not like super amazing. I'm sure you can find lots of other factors to build like a much neater model or whatever. But the point is it's at least statistically significant. It's very, very solidly statistically significant. No statistician would ever scoff at this. They would maybe want to add other factors to the model, but they would certainly use this factor. That's basically my point. So the point is, if you've got expectations of where populations are going to go, which the Census Bureau does population projections, and their projections are generally pretty accurate. They skew a little bit, like they can be off by like 1 percentage point either direction over a decade, which can be a lot. That's still a couple million, right? But that's not terrible. That's not terrible. Like they could be within a decent range. So the point is like you can make a pretty good prediction over what you would expect housing to do for the United States, and housing starts. Like I said, this is housing starts. So like I said, I keep coming back over to the regionals. I was kind of looking at those same statistics by the regions. Now it turns out if you run the statistics on the regions, not all of them come out as strong and as clean. First of all, we don't have nearly as much data. This only goes for them. It only goes back to 1983, and then I end up using monthly data rather than yearly data, and that makes a big difference. Like you end up having the shorter the time period you use for your data points, the more statistical noise you have whenever you're doing statistical models. So if you use monthly data is going to be better than daily data, and yearly data is going to be better than monthly data. But unfortunately, you're going to have a lot less data points, right? That's the caveat to that. So you always try to find like a sweet spot when you're working with statistical models of saying like, well, what's the sweet spot that gets me a large sample size, but also gets me less noise in my model? And so like when I have data going back 100 years, I can use yearly data. But when I have data going back to 1980s, I have to use the monthly data if I want to have like a good sample size. So point is I run the models using monthly data on the regional data. And a couple of the models were very statistically strong and the other ones not so much. So it's not so clean. But the point is I do plan to make some, this is stuff I'm going to be using in my models for trying to figure out the revenues for the companies. Is I can use either the regional model, or I could just use the national model for a region. That's the thing, is I could just, technically the region is in there, and so I could just use it as a partial, and that's going to be an approximation. It could still be used as a way to approximate it. So point is these are literally how I'm going to be building my revenue models, is looking at the relationship between population growth and housing starts, and then other various ratios from there. So anyway, moving forward onward from there, here's those graphs as I was talking about that kind of compares the entire cycle. Look at like permits, the starts, the under construction, the for sale, and the sold across each of the regions. So we have the West regions, why it's blue, South region, red, Northeast, and then Midwest, same colors that we've been looking at, tried to make things consistent. But here you can kind of see how it looks throughout the cycle. So like the black line is the when it's sold, right? So the black line is like the final thing. And then the way I kind of like tried to look at it is we have like the gray lines are the permits and the start. So those are kind of like the leading indicators, right? Those are the things where things are just now getting going. So you can kind of look at like where the gray lines are. You don't necessarily mind the gray lines being high, because the gray lines being high is kind of like an indicator that maybe the black lines are going to go higher in the future. But then like the whiter lines are the under construction for sale. So those are the ones that you don't necessarily want those to be super high. You kind of want those to be below the black lines, because those are kind of indicators that your inventories are growing faster than your sales potentially, right? So this is kind of like a way to like look at what is this current sales cycle look like within the region, and like looking at like the differences between the colors. So like I said, you want the kind of the darker gray to be above the black, and you want the lighter gray to be below the black, and then overall you want the black to be high, right? You want the black line in general to just be going up. So thinking about that, in the West region, not those sales have definitely been coming down pretty low. Like, it's one of the reasons, like, I think it's a good reason to believe that maybe the West is bottoming, because it's at a pretty low point right now. So this is potentially a good spot to be sort of buying in. The gray lines are pretty flat, so they're not necessarily pushing towards strong indications there. And then the lower gray lines are about the same level as the black lines, unfortunately, but the black line is very low. So it's one of those things where, like, as this starts to rebound, that could be in a relatively good position, but for at least for the time being, it's not amazing. The South region, things are looking pretty great in terms of those permits and starts. They're pushing upward a little bit, so the sales could continue to move pretty well for the South. And then that goes to show with what we were saying about the inventories potentially being a little on the high side in the South relative to their sales. And we were saying that like the months for them is maybe a little high. Well, maybe that's not so bad. If we're looking at their sales cycle, and it seems to show that the permits and the starts are pushing towards potentially higher sales in the near term future, then maybe they're right to be holding on to those inventories, right? Like that's one of the things we were saying. We're like, maybe they have their reasons why they're doing that. So this is actually kind of, I would say, like a bullish kind of setup for these lines. This is like sort of what you want to see here. This is a little bit muddled. It's not bearish necessarily, but it's a bit muddled. This is kind of bullish. And then coming over here, looking at similarly, black line's very low. Gray lines are above the black lines, which is good, but they're not really moving upward too much. That's not really amazing. And then the white lines, one of them is at the same level as the black, and the other one's higher. That's not good. That's not really what we want to see for the Northeast. Unfortunately, that's not the setup we want to see very well. And then looking in the Midwest, the dark gray lines are well above the black and somewhat moving upward, but definitely not so much not a super strong consistent case. It's like it's sort of pushing upward a little bit, so maybe it's a little bit good for them, but not amazing. And then the black line is below the kind of the lighter line, so definitely they have room to recover there. So it's like I would say is like if I had to kind of like put them in order, I would say southeast or south region looks the most bullish, followed by the west region, and then the Midwest looks somewhat bearish, but not massively bearish. Potentially has room to move into better territory as well, though. While the Northeast definitely looks kind of somewhat bearish. Like I said, like that's sort of like why I put these charts together, and who knows how well that works as an actual signal. But that's kind of the idea, is that like you're kind of trying to think about like the differences in the movements between the different color types on these charts, and how that thinks about whether or not we're kind of in a bullish pattern or a non-bullish pattern from the fundamentals. Like I said, like we're looking at charts here, but this is fundamental data, right? Like this is actual fundamental data. This isn't some random trades or something. So it's a we're charting over here, but it's a more fundamental form of charting. Anyway, so moving past that, that's pretty much all of the like straight up housing data. But then I did actually also include some look at some like household economic statistics too, because obviously people have to buy the homes, right? Like there's people have to buy the homes, they have to live in the homes, they have to be able to afford the homes. So we wanted to look at some of that stuff as well. Mean household incomes by the regions, they're actually pretty closely grouped for the most part. They're not necessarily that far apart by the regions. You might have expected a little bit of a bigger difference there. Same thing between the COGRs, a little bit of a stronger COGR in the West, but not by a massive difference. And that's over a 3-year COGR, so it's not a huge difference there. Same thing for the medians. Medians a little bit lower, looks like, in the South, relative to the other groupings, but not by a huge wide shot. Technically, they were lower here as well, but that's what it is. Same, the growth rates pretty closely clumped together, a little bit lower for the Northeast, but not massively so. And mean home price to income ratio. So this is a metric people often talk about when people talk about like home affordability. Is like how many times is the home price relative to the incomes of the household. And people have often said like kind of like 3 is considered affordable, and 4 is like kind of starting to get towards pricey. 3.5 is pretty typical historically, as you kind of see right here. That is indeed the case across the averages, and I did the same thing with the medians down here, which is pretty somewhat similar. And then you can see that the Northeast really starting to push upward over time, pretty consistently across those time series there, with also the West as well, kind of pushing up a little bit higher than the other categories, but not nearly as high as the Northeast. And then the average to median income ratio, so the ratio between the average and the median household incomes themselves. So like how does that skew work? And then obviously, because we were talking about the average and the median home price differences, but we can do the same thing with the incomes. Here you can see some skew. The skew is definitely moving upward over time, and that would be income inequality. By the way, this is income inequality on a graph shown right here. That this is what people are complaining about right here in a graph. You can see back in the mid 70s, we were at like 10% of a difference between average and median incomes in these regions. And then that has pushed to more like 1.3 to 1.4. Less so in the Midwest, apparently, than the other regions, which is interesting. Not by a huge margin, but somewhat. And then, like I said, we talked about the median home income price ratios. And then we have the unemployment ratios. Unemployment ratios pretty closely grouped together. You can see that there is a little bit of higher unemployment currently in the West than the other groupings by like 0.5% to 1%, depending on which one we're comparing it to. I would point out, so that's potentially something to maybe worry about. But obviously, all 4 are still at relatively low levels. And then I would also point out that the West seemingly has always had a little bit of a higher unemployment rate, or always, I should say, for like the last 30 years or so. That's been pretty consistently the case for most of the time. So potentially that's not actually necessarily abnormal. Potentially that's just kind of something something dynamically structural about the what's going on in the region there. I don't know, but either way, the point is unemployment's pretty safe and fine, which is fine. It's like I said, the incomes are what pays for the home, so that's why we talked about all the income related stuff. Unemployment is obviously people have to be able to keep the job to get the income. But then I also included worker productivity year over year growth, which we only get on a yearly uh, or quarterly basis, so we don't have it in the most recent year and or have it going back nearly as far. But the reason why I put this in here is because I think worker productivity is probably like one of the single biggest factors that's going to decide whether or not companies want to start hiring more people in a region over another region, right? So if the South and the West are more productive than the other two regions, which seems to be the case, at least in the most recent year over year period, and it seems that the West was more productive in general for a solid several years, at least during this is like kind of like the Trump years, it looks like, for the most part. Then it's like that's going to be the place where people want to start hiring more people because they're more productive. That means it's going to be more profitable for business to hire more people in those regions. So very important to look at. So yeah, unemployment, worker productivity, unemployment year or not year employment year over year growth. So like this is the actual hiring of the or the actual gains of those jobs, and then you can see some pushes and periods where the West is a little bit higher, but not necessarily too much difference there. So you can see like a difference in productivity for a few years, but maybe not so much so that we necessarily see huge differences there. Obviously, the cost of the employees would make a difference as well. In employment growth, pretty flat-ish in most of the regions, so definitely not strong. Potential room for them to rebound, or maybe we're sliding further. We'll see. But then also I can continue from there further. There's also data on the Federal Reserve website for business applications and business formation. So taking a look at that too, it's like here's people trying to start businesses in the different regions, and very interesting to see that the South has had consistently more business applications per capita. Per capita, again, we're adjusting for the populations already in the South relative to the other regions. So it's very interesting to see. And then the actual successful formations of business, the West seems to stand out. So that's also very interesting to see. I don't know necessarily what drives those particular details, but very interesting to see in the data. So like I said, it's a ton of stuff we just ran through, like tons of stuff. And like I kind of said at the start, it's like you don't really want to look at any one point when you're trying to like make your thesis about what you think is going on in housing. The point is like I really do think like you really kind of want to look at all of this because like all of this together kind of helps paint a picture of like which regions do you think are doing better. And as I had said before, like when I was initially doing my quality lists analysis that I was discussing, I had said, "Oh, my biases are towards the South and the West." I had said Southwest, Southeast. Really, I said like kind of like the southern band of the United States, pushing all the way across east to west, was kind of the areas I said I was bullish on. And you can kind of see that turns out like there was reasons why I was bullish on it. Like I could have told you some of this data to a certain extent. Like I could have said, "Oh, this, and this," but I didn't know all of it and I didn't necessarily know the exact numbers. I just sort of knew some of these things were true in the back of my mind a little bit. I'd seen some of this data already, but seeing all of it together, it kind of helps paint that picture. So, like I said, like for example, like these factors may matter a lot in my mind. The idea that it's easier to form businesses in the West is a super bullish thing in my mind. Or people are trying to form more businesses in the South is a pretty bullish factor in my mind. Higher worker productivity is a pretty bullish factor in my mind because that means people are going to hire more workers. And if people are going to hire more workers, that means people can afford more homes. And so that means people are going to build more homes. As you can see, like why I think those things matter a lot. I think the affordability thing matters a lot too. So it's nice to see that, like for example, here in the West, we're seeing it come down a little bit. In the South, it's already not terrible. But it would be better if these things were a little bit better. And then like like I said, like these factors about the kind of the bullish setup. I like seeing that bullish setup for the South. I wish it was a little bit more bullish of a setup for the West. But I do think that the West has other things going on for it too. Like I said, like I think the inventories are pretty low relative to the average sales level that we would maybe expect them to come back to. So like the mean reversion in sales in the West, I think would be very bullish on the inventory levels in the West. So it's one of those things where it's like I maintain my bullishness on the kind of like southwest southeast of the United States. So now I'm pushing my bullishness even more towards the southwest. That's kind of the thing is like I'm actually pushed my bullishness more towards the West because, like I said, I was bullish more on like these regions, right? But they don't conform with those census regions super well because if I want the West, I sort of have to take the Northwest in with it, and I'm not really as bullish on the Northwest. But the point is, the West region as a whole, the data looks pretty clean. It's just that I do know that the data is pretty heavily weighted towards California and Arizona because that's like the larger population centers, and then maybe a decent amount of some Denver thrown in there as well. Because like really is like down here is where the most of the population is. Just like I said, like Texas and Florida is really like the huge population portions of the South. Though obviously the South is pretty populous throughout, but South either way, it's Texas and Florida. It's the thing there. So yeah, that's like I said, tons of data to look at. But I think it gives a pretty good picture of like, yeah, where you can think about housing. Like, is there some reasons to worry about some supply aspects? Yes. But I would say that there's also a pretty consistent trend in terms of like housing relative to population growth. And so you really just have to think like, okay, what do I think is happening with population growth? And there are projections about where populations are going, so you can actually make pretty good, solid predictions about like what a steady state housing market would look like. And so we can kind of look past, well, maybe what's going to happen this year or next year. And that's the thing is because like I said, I'm dipping my toes into housing and I'm trying to build a solid model and I'm trying to build confidence to maybe build up that position into a major large one. And the truth is that it's possible that I will build up this position and it will go down a ton in the next year because the tariffs uh, cause inflation to go up a little bit higher, and then eventually global trade comes to a halt, and then eventually that drags the business cycle down under, and then suddenly housing gets pulled down with the business cycle. That's totally possible that happens, but that doesn't change the fact that the demographics are happening the way they are happening, right? So it means that even if this year is ends up being kind of ugly for home builders, and maybe next year ends up potentially being ugly for home builders, that 5 to 10 years from now, um, 5 to 10 years from now, this graph and this strong correlation, I feel like will still be true, right? Like that's the thing. And what's one of the things that like is kind of getting me bullish about this industry is that I like almost like the feeling of certainty I get from this data. Like I said, it's not certainty in the short run. It's in fact there's very much no certainty in the short run. But it's people have to live somewhere. Homes are going to be built. We're not going to just change the way we build homes overnight. We're not going to have a huge technological shift in this industry. Um, it's fragmented on the bottom end of the scale, but there are some pretty big players, and those big players, yeah, being one of those big players gives you a good scale that I think helps protect you from a lot of the shifts because you get exposure to multiple regions. And then also some of the home builders are better protected than others. Like I said, I'm focused on Lennar. Lennar is a net cash company, so that kind of puts them in a good position. They're currently working to go towards like a land light model, which puts them in a position to not be as affected by supply issues and downturns as much. We'll see how that works out for them. I think there's arguments kind of for both business models actually, land light versus land heavy. I think there's actually arguments for both. So I think it kind of depends on how you sell it. I think. But the point is so we'll see. Lennar is pretty heavy on the west relative to other regions, but they're also heavy on the south as well. Like I said, I am compiling a bunch of data to try to do this kind of regional comparison. So far, I've compiled the data for Lennar, DR Horton, and Pulte. I was working on NVR a little bit last night. I'll probably continue doing that tonight and finish that up. And then I plan to also do KBH. I was doing just the largest one, so I was originally planning to do Meritage, but I decided I'm going to switch and make the last fifth one that I want to do because by doing five of them, I managed and doing them in this order, I managed to get to literally about 1/3 of the total homes sold across the United States, just in those top five. So, like I said, that's kind of like the concentration of the market. It's that the top five players is about 1/3 of the market. But then below that, it actually gets pretty fragmented below that. So what that does is that creates lots of opportunity for consolidation in downturns, right? So it's like if you have a net cash large player like Lennar, which has 10% of the market nationally, then you can be in a position to concentrate and consolidate during a downturn. But anyway, getting over to, like I said, I'm switching the fifth one that I'm doing the analysis on to KBH because they have much larger Western exposure. And I found that out of the four I was looking at, I was getting a lot more Eastern exposure on that, like I said, that kind of East-West split that I'm going to end up doing for these groupings. Because like I said, we were talking about four regions for the regional data. Once I start looking at the company data, I'm actually just going to be doing West versus a large Eastern grouping, which, like I said, isn't super ideal. I would have preferred to kind of have the South split off from that, but I'm kind of forced to do it that way, just because of the way these companies have their segments. Like a bunch of them have those regions split up in weird ways, where they have like Texas mixed up with the Midwest, and then parts of the eastern seaboard all mixed up with the Northeast. Yeah, like weird ways that they combine the segments for some of them. So we're just doing East West for the companies, which I think still works well because, like I said, part of my bullishness now, having done the regional analysis, has really just shifted my mind towards bullishness on the West in particular. That's like really where I feel like I see the strongest reasons to be bullish long term. Like I said, in the short term, I do think that the South is actually pretty decently well set up by that kind of like the current setup of their cycle. But like the longer term factors about population growth dynamics and business growth dynamics and income growth dynamics, I'm focused more. I think the West is better, and which is good because, like I said, the Lennar I think has a bit of a stronger and better presence in the West compared to some of the other players. And KBH is stronger in the West too. So I think adding them to the mix will do a better mix there. Anyway, that's pretty much it on all the housing stuff. Man, there's a lot, like I said, a ton of stuff that I had to go through there, but it's like like I said, I've been working on this stuff for like the housing stuff the last few weeks, and then I'm the business cycle stuff the last several weeks prior to that, and a lot of the other like model stuff for like a month and a half worth of research. I haven't talked to you guys in a long time, so a lot of stuff to look at, and other stuff I'm working on. So hopefully next week I will be live again. Hopefully my life won't fall apart again. And like I got a new cat, by the way. I didn't actually say it at the start when I was talking about my life falling apart, but my previous cat passed away. That's actually what happened. For all the viewers that did not know, well, only a couple of you that I talked to knew about that. But I did get a new kitten, so it's him laying on the bed over there. So hopefully my life will be happy and stable again now that the holidays is over, and everything's a little bit more stable, and I'll be hopefully streaming again next week. And when I stream hopefully next week, I will have this analysis done because, like I said, I'm kind of three not three quarters, maybe like 2/3 of the way done now with it. So I'll hopefully be done with it next week. And then that means I can start building those models based off of the population growth, which means I can have like a more formal model for Lennar, or maybe not Lennar. Like I said, it's like I do think Lennar looks like potentially the right choice given their exposure in the West, but who knows? I'm still trying to take a kind of unbiased look at all of them and kind of like take my pick there. But either way, hopefully starting to concentrate a lot more into that because yeah, right now it's just 1.5% of my portfolio, and I wouldn't mind maybe pushing it up to 10% or something if we really feel that bullish on the industry. It's like I like this industry because I really do feel like 10 years from now there's no reason it won't be just as great of an industry 10 years from now. The prices the stocks are selling at may not be as great 10 years from now. So that doesn't mean we end up holding the stock for 10 years, but the industry I think is just a good industry to be in. It's just a question about your entry point, right? Like the year you choose to enter home building may be a very bad year to enter home building. But I feel like it's hard for it to be a bad decade to enter home building. We did have a bad decade to enter home building back after the GFC, but I feel like that was a pretty rare fluke. And that's kind of the point. So it's like one of those things where it's like this year might not be the right year to enter home building, but I do think it's a good decade to enter home building. So I really do want to do so. Beyond that, because we talked about home builders pretty much entirely here today. But I said FG, my number one. I actually have been doing a lot of side research still on the annuities and pension business too. So hopefully after next week, which like I said, next week we'll still be talking home builders, but we'll be talking more about individual companies of home builders and comparing them. But then hopefully after that, we'll be shifting to talking about insurance for a few weeks. But maybe I'll wait a week or two off on that. Maybe we'll talk about something in the interim. It kind of depends on the 10K because I do want to get that FG 10K, but I'm getting bullish on FG again too. So I kind of want to push my FG position to like 20%. Not gonna lie. Um, I more to the valuation table. I do have a soft new current fair value of FG of about $70. Um, you could call me crazy if you want. I don't know. I think it's not too crazy. Looking, like, I'm not gonna get into all the details of it, but long story short, I think the margins are conservative. I think the terminal multiple on it is conservative. It's the revenues that I'm bullish on that gets me to that number there. So it's like it does basically imply a doubling in revenues over a 10-year period. But beyond that, I think all the other assumptions are pretty conservative. It's just the revenue growth part that I'm very bullish suddenly again on. But yeah, and call me crazy, I don't know, but I do feel like a combination of annuities, pension transfers, and home building could be a fantastic 10-year moneymaker. So that's and gold mines. Got to throw the gold mines in there too because I am still relentlessly bullish on gold. Everything about the economy has only proven everything I've ever thought about gold right for the most part in the last couple of years. So anyway, that's pretty much it for today. Those last few comments there. I know it's from Scott. Talking about the shorts on the builders. Where were you seeing the shorts? Is it on in Lennar? Lennar has that shorts. Is that what you're talking about? Because I don't think I was even aware necessarily. Is that what it is? Oh, Must be talking about something else. 22. Did I miss something? I don't know. DFH Insider ownership huge. Sorry about Kitty. Yeah, I appreciate that, man. It was really hard to go through, but luckily we're kind of making it through. But anyway, so like I said, that's pretty much it for today. I'll catch you all hopefully next week. Talk about home builders once more. All right. Thanks.